This presentation will cover the financial accounting and tax effects of making a charitable contribution, as well as how we treat any differences between the two on the books and financial reports of the company. As we work through the details of these issues, we should have a good understanding of the following key terms. Book value is the amount that the asset is reported on the company's books and is a financial accounting figure. Adjusted basis is similar to book value in that it reflects the original acquisition cost of the asset minus adjustments for depreciation, etc. But adjusted basis is used for tax purposes. Finally, we need to keep in mind that fair market value means what the asset is worth today. These three figures and the differences between them are the basis of the concepts discussed in this presentation. To understand the effects of a charitable contribution on financial reporting, let's take a look at the components of the journal entry that would be recorded when a contribution is made. First, the fair market value of the contributed asset is expensed. If the contribution is in cash, this is easy to figure out. But if the company contributes a fixed asset or appreciated investment property, an appraisal may be necessary to determine the fair market value. Next, the asset is removed from the books at its book value. Again, for cash, this is easy. For a depreciated asset, however, this involves crediting the asset at its initial purchase price and debiting all accumulated depreciation for the asset. But for any asset, the net effect of this step is a credit in the amount of the asset's current book value. The last component of the journal entry is recording a gain for the difference between fair market value and book value. If the fair market value is less than book value, the amount will revert to the debit side and be recorded as a loss.
Now we will discuss the tax treatment of a charitable donation. In order for a charitable donation to be deductible on the tax return, the donation must be to a qualified charity. These charities are described in the Internal Revenue Code section 170C and in publication 78. Corporations also have a limit to the amount of charitable deduction they can take. In the Internal Revenue Code section 170B2A, it tells us that the charitable deduction cannot exceed 10% of the corporation's modified taxable income. However, any deduction that was over the limitation can be carried forward to future years. This carry forward amount can be carried forward up to 5 years. However, this amount is subject to the current year limitation considered after the charitable contributions of the current year have been considered. This amount is also limited to the amount of the carry forward deduction not yet used. The easiest contribution to treat for tax purposes are cash and cash equivalents. With these contributions, the corporation does not recognize any gain or loss, and the deduction allowed is simply the fair market value of the property, the amount of the cash.
Now we will discuss the tax consequences of donating non-cash property. Let's begin with appreciated tangible property. This type of property can be divided into two categories: ordinary property and long-term capital property. Ordinary property includes investment property held for less than 1 year, inventory, and property subject to depreciation recapture. For tax purposes, the donation of ordinary property results in no gain recognition. The charitable contribution deduction is equal to adjusted basis and limited to 10% of modified taxable income. In certain cases, a corporation may deduct the property's adjusted basis plus 1/2 of the excess of the property's fair market value over its adjusted basis. However, these cases are beyond the scope of this presentation. That brings us to our second category of tangible property, that is, long-term capital property. This includes all property that would result in a long-term capital gain if the property was sold. For tax purposes, a donation of long-term capital property results in no gain recognition, and the charitable contribution deduction is equal to the fair market value of the property limited to 10% of modified taxable income. Special restrictions on long-term capital property apply in the following cases. A corporation donates tangible personal property and the charitable organization's use of the property is unrelated to its business, or a corporation donates appreciated property to certain private non-operating foundations. In either of these cases, the charitable contribution deduction would be limited to adjusted basis. This completes our discussion of charitable contributions of tangible property. A corporation may also donate intangible property. For tax purposes, the treatment of this donation would result in no gain recognition, and the charitable contribution deduction is equal to the lesser of fair market value or adjusted basis, limited to 10% of modified taxable income.
Permanent differences will arise due to a charitable contribution in a few different ways. Some of these causes have already been discussed in previous slides. If there is a difference in the book value versus the adjusted basis, in this situation the deductions allowed for book and tax purposes will never be the same because the originating bases were different to begin with. Therefore, this is a permanent difference which will never reverse. As mentioned previously, in order for a charitable contribution to be deductible for tax purposes, the contribution must be made to a qualified charity. If the contribution is not made to a qualified charity, the deduction will never be allowed for tax purposes and a permanent difference will be created. A permanent difference will also be created if a carry forward expires unused after 5 years. Finally, if there is a gain for financial purposes when dealing with a charitable contribution, there will be a permanent difference created because no gain is recognized for tax purposes. These permanent differences create changes in the effective tax rate. Now let's look at temporary differences. These differences occur when the expense taken for financial accounting is different from the deduction allowed for tax. The difference between financial and tax treatment creates a carry forward. In order for this carry forward to be used, the amount must be greater than 10% of modified taxable income. These carry forwards create deferred tax assets. Deferred tax assets are unfavorable because they are deductions that cannot be taken for tax purposes currently, but will be available in future years if the carry forward amount will meet the criteria specified previously.
Now, please pause the presentation, read through the problem, and work out the financial accounting and tax consequences and any permanent or temporary differences.
Here is the journal entry that will be made for financial purposes. As you can see, the contribution is expensed at the full fair market value of the land. A gain is recorded for the difference between the current market value and the purchase price, which also happens to be the current book value as this is an investment property. Finally, the book value of the property is removed from the books.
Now consider the tax consequences of the charitable donation. There is no gain recognized in conjunction with the donation. The potential deduction of $300,000 is limited to 10% of the modified taxable income, or $160,000.
Because the financial expense exceeded the tax deduction by $140,000, we will record a deferred tax asset and associated deferred tax benefit of $47,600. A permanent difference of $100,000 arises from the gain recorded for financial purposes, but not included in taxable income. We originally expected the $140,000 to be deductible within the 5-year carry-forward period. However, at the end of 2014, $40,000 remains from the carry-forward, and as a result, creates a permanent difference. For more information about charitable contributions, related book-to-tax differences, and necessary financial reporting, please contact Alexis Harrison, Trevor Nelson, Bryce Wallentyne, or Alicia Young at Brigham Young University.